With the 2025 election heating up and Trump gaining traction, investors are asking what happens to markets if he takes office again. Start with the backbone of American business, the Vanguard S&P 500 ETF, also known as VOO. VOO gives exposure to the 500 largest companies in the US. Think Apple, Microsoft, Google, Amazon, Nvidia. Here's what makes VOO so compelling in a Trump-style economic environment. If tax cuts return, if corporate regulations loosen, and if America leans into pro-business policies again, who benefits the most? The giants. The companies already sitting on billions in cash, ready to expand, buy back shares, and pay dividends. VOO captures all of that with one click. At around $567 per share, it might seem pricey, but most brokerages allow fractional shares now. That means anyone can get in. The expense ratio is just 0.03%. That's $3 per year for every $10,000 invested. Compare that to mutual funds charging $100 to $200. That kind of cost difference adds up over decades, potentially hundreds of thousands, even millions saved in fees alone. VOO isn't trying to beat the market. It simply matches it, historically outperforming most actively managed funds. Even Warren Buffett recommends investing in a low-cost S&P 500 fund as the best move for most people. While others are chasing hype and burning out trying to time the market, VOO investors are quietly compounding and winning. Wow! Others are chasing hype and burning out trying to time the market? VOO investors are quietly compounding and winning. Under Trump, if the economy surges with policies that support growth and large caps rally, VOO will ride that momentum smoothly and efficiently. It's like owning a slice of the entire US economy and getting paid while doing it. Let's shift gears a bit. Growth is great, but stability? That's what keeps portfolios from falling apart during volatility. That's where SCHD, the Schwab US Dividend Equity ETF, enters the picture. This ETF focuses on high-quality companies that consistently pay dividends, and more importantly, companies that can afford to keep paying those dividends even when things get rough. Think companies like Coca-Cola, Verizon, PepsiCo, Texas Instruments, and Cisco. These are dividend giants. They've been through recessions, global disruptions, policy shifts, and they keep sending out those dividend checks. Right now, SCHD offers a dividend yield of around 4%. That means for every $1,000 invested, about $40 a year comes back. The companies in SCHD are chosen based on real financial strength, strong free cash flow, manageable debt, and long-term performance. During downturns, investors often flock to safety. Dividend-paying stocks are usually at the top of that list. CHD offers a cushion during storms, and under favorable policies, its top holdings can benefit as industries gain steam. When held in a tax-deferred account like an IRA or 401k, dividends compound tax-free until retirement. Reinvested dividends buy more shares, generating more dividends and creating a powerful compounding effect over time. The expense ratio? Just 0.06%. That's $6 a year per $10,000 invested. It's another example of keeping more of what's earned. SCHD isn't meant to chase hype. It's built for consistency. It brings balance to a portfolio, generates income, and serves as a solid anchor when growth assets take a hit. In a Trump 2025 economy that rewards U.S. companies returning capital to shareholders, SCHD could shine brighter than ever. These companies aren't trying to triple in size overnight. They're focused on steady execution, strong fundamentals, and rewarding investors over the long haul. SCHD offers peace of mind, with more capital likely to flow into dividend strategies as baby boomers retire. Demand for funds like SCHD could continue rising. It's not the flashiest play in the portfolio, but it's the one that lets people sleep better at night, especially when the market turns noisy.